Good evening, everyone, and welcome to Juwai IQI Canada Evening Talk. My name is Yousaf Iqbal, country head of Juwai IQI Canada. Good evening from Canada and good morning to Malaysia. It's that time of the month again when we bring our chief economist, Shan Saeed, to get his view about the world economies on that. Before I get into that, people who are listening to us in Malaysia, happy Merdeka Day. So today is Independence Day, which is 64th day of Malaysia. How are you doing, Sean?
Good morning from Kuala Lumpur. Yes, happy Mardika Day. I am doing good, Yusuf. Thanks for having me again, and thank you very much for sending some wonderful T-shirts and hoodie for my son in Lahore. Thank you so much. I
My
really
my
appreciate.
my pleasure, sir. My pleasure. My pleasure. You know what, Sean? It goes before without saying that. That I always say that when I am in Kuala Lumpur myself, in fact, with Umar as well. You are our host right from the time we enter. Till the time we leave. So right from every small thing you take care of. So thank you very much for that.
Thank you.
So before I get into the question, Sean, I know today is a day off as well because the Independence Day. How's the situation overall getting in KL? I guess a lot of people are getting vaccinated now and things are getting better.
Yes, things are getting better. More than 50% of the population has been vaccinated. The numbers are coming down. The government has done one gentleman by the name of Khairi Jamaluddin. He has done a great work. He's Oxford educated and a very smart, great communication skills. He has done a good job. He has come back as a health minister. So we expect the economy to open up by end of September, hopefully. So let's
Nice.
see, fingers crossed.
Fingers crossed. I'm looking forward. As soon as it opens up, it's been almost like a year and a half now, more than that, almost now. Since I was in Malaysia, so looking forward for that. So before we start, let's say good morning to Lily, all the way from Australia. Thank you so much, Lily, for joining us.
Good morning.
So, Sean, let's get started. Wall Street Journal shared on August 17, 2021, this 7 trillion cash. Like, this is massive, right? Cruise line operators and airlines are among the companies sitting on a record amount of cash amid lingering uncertainty about COVID-19 disruptions. That explains this $7 trillion cash insight and its impact on the market. What's your take on this, Sean?
Yes, Yusuf, you are absolutely right. The big organizations, especially that you have mentioned, airlines and other operators, they are sitting on cash. $7 trillion. What does it translate to? It means that organizations are looking for opportunities. At the same time, risks are getting bigger and bigger. So once you have opportunities and risks, you have a trade-off, where to go and where to tap the market to leverage from it, and how you can turn this situation in your favor. So I think when people are sitting on $7 trillion of cash or even more, they are looking for opportunities in the equity markets. They are looking for opportunities in tangible assets. They are looking for opportunities in distressed assets. They are going into private capital. Later, I will explain what Yale Endowment is doing. So I think this is an opportunity for many organizations because a lot of assets are available in the market. And in every situation, you have opportunities and risk associated in every market. So right now, I think this signifies that organizations are looking for opportunities. At the same time, they want to mitigate the risk and they want to take position in tangible assets. So it's a growth opportunity for many organizations. At the same time, they want to mitigate the risk in order to move ahead. The markets will stay volatile for the next 2 to 3 years. The markets are not settling down, and it's your ability, it's your cleverness, it's your smartness, how you're going to tap the opportunities in your favor.
Amazing. Thank you for that. Let's say hi to good morning, good evening to Kunjan, all the way from Malaysia. Thank you for joining us. And
Good
Assalamu
evening.
alaikum, Kashif Ansari, our group CEO. Thank you so much for
Awesome.
joining us, always on that. So, another question to you is that the inflation, the US Fed and the stagflation. So, actually, I'm going to ask you what stagflation is again. I know we talked about it on the program, but before that, how are you going to control the inflation? I mean, it's rising in USA since February from a 2.6% to 5.4% in July, but Fed is denying and saying that it's transitory and it will come down soon. But you have been saying since May 21, that this inflation numbers are serious and you have proven correct. I mean, we are heading towards the terms of inflation and deflation. Can you please elaborate? And before that, let's talk about a little bit about stagflation.
Yes, stagflation is when your inflation is high, your growth is low, and you have higher unemployment. So we are heading towards the same era of 1970s where we had stagflation. And if you recall, in that era, two asset classes outshine quite significantly. One was real estate, and the other was gold and silver. So history has taught us that in terms of stagflation, real estate and commodities are the best hedge against inflation. So what you have just asked is very much relevant in the market since November 2020. If you recall, in our newsletter, I mentioned that we are heading for stagflation. At that time, a lot of people they questioned me, Chan, what are you talking about? Inflation will be subdued. And I said, no, inflation won't be subdued. So from February onwards, if you see, inflation has risen, and now inflation is at 5.4%. And when I was at Estrovani since May, I have been saying that, Fed and Janet Yellen, they are misreading the market. And this inflation is serious. And right now, if you go to US, gasoline prices are up, the grocery prices are up, food items are up. So these are the basics. When you people go out in US, 50% of the salaries are spent on buying grocery items. So when grocery items are going up, your energy prices are going up. You can't say that inflation will remain subdued. Inflation is will remain strong. It might come down from 5.4%, it might come down to 4.8 or 4.9, but inflation in US will remain strong. One of the reasons is the US dollar is staying weaker. This is one of the factors that contributes to inflation. The second factor that contributes to inflation is higher energy prices. We have seen energy prices coming down from $77 to 68, and right now, when I speak to you, energy prices are $72. Energy prices are $72 per barrel. They are up by almost 35% year to date. So when your energy prices are up, your currency is going down. This is a perfect recipe for inflation. And Fed has not been able to fathom this phenomena. Since last year, they have been saying that we want to target 2% inflation, but they could not get 2% inflation because they did not let the currency depreciate. So once your currency depreciates, that's the point, when inflation comes in. So I think inflation will remain serious. I expect this inflation number to be above 4.95% in the last quarter as well.
Okay, so you think the inflation will continue to be around like 5% on an average.
Absolutely.
That's what we're expecting
Absolutely.
on that. Great.
Yeah.
Okay, we're going to say hi to a couple of people who joined us. Hey, Bob, all the way from Toronto. Good morning.
Good
Good
morning.
evening from Toronto, and good morning to Malaysia for sure.
Good
And
evening to Toronto.
good morning. Thank you so much for joining us on that. This leads to my next question. Jackson Hole meeting ended that the Fed chair, Jerome Powell, said that bonds tapering would commence by year end or early next year. Do you buy the argument and tell our listeners whether it's balance sheet, tapering or asset tapering? That is U.S. Treasury and mortgage.
Absolutely. I don't think that during the Jackson Hole meeting last Friday, Fed Chair Jerome Powell, he gave a very perplexing view. He said, we might start tapering. What is tapering? You reduce your bond buying from $120 billion per month to maybe $100 billion. You're buying U.S. Treasury and you're buying mortgage-backed securities. But in my opinion, the markets are so volatile right now, and there are factors to it that I will share with you. There are three factors. One is your delta, second is your growth, and third is your market. And what does it mean is delta variant is getting stronger. 40% of the new cases are coming from Florida and Texas, where people have not been vaccinated, and that's the problem. The second factor, the growth is not showing its head. When the growth is not showing its head, how can taper bonds or you can increase interest rate? So I think, in my opinion, this will happen in December next year. It won't be happening this year,
Mhm.
because if you were to buy, if you were to reduce bond buying, the markets will get volatile. And we have seen, if you see the last minutes from 27, 28 July, the moment Fed mentioned that we will start bond tapering, the markets went haywire. And the markets were very volatile, and suddenly the markets could not assimilate that Fed is sharing that, the bond purchase will going to reduce by end of this year or early next year. So I think because of delta, market, and growth, I don't see this happening. And why this is different from 2018, when Jerome Powell, he mentioned there are two types of tapering. One is your balance sheet tapering. What does it mean? It means that we are going to reduce the size of the balance sheet. Again, in 2018, the markets went volatile. October 2018, investors lost $5 trillion in equity markets alone. In February 2020, investors lost $6 trillion. So it is not about millions or billions. We're talking about trillions with T.
No.
So $6 trillion, February 2020, wipe off of the market. So I think at that time, Jerome Powell, he reversed course, and he asked the bankers what I should be doing. On 24 December 2018, all the bankers called and said, you should not reduce the balance sheet, you should increase your balance sheet. So I think at that time, if Fed has not increased its balance sheet, many people would have a very bad Christmas day on 25th December. So I think he has learned his lesson, that he cannot taper the bond buying or balance sheet abruptly. He has to give some time to the market to understand. So I think this round, he's talking about reducing the assets, which is like the US Treasury and mortgage backed securities. This is not happening because of Delta, because of growth, and because markets are not accepting that Fed is going to taper very soon. So we are expecting a July IQI, that bond tapering will happen, actual tapering will happen in December next year. By this year, December, or maybe next year, early January, they might reduce from 120 to $100 billion, but they will continue to purchase US Treasury and the mortgage-backed security for the next 12 months. This is not going to stop very soon. So balance sheet tapering or asset tapering, it will not happen very soon. It will take some time. So we are expecting 12 to 15 months that it will come into the market.
Great. We're going to say hi to a few people, and there's a question as well. So, good morning from Malaysia. Again, a very good morning. Again, Assalamu alaikum. And, for all the people who joined us from Malaysia, happy Mardika Day to all of you. And there's a question which we have from Malaysia, from Kundu. What is your view of US 3 trillion debt?
3 trillion of infrastructure that you're talking about. Am I right in understanding?
I guess so. I would
Okay,
think so.
the 3 trillion infrastructure investment, it will not happen overnight. It will take some time. Yes, it's going to create momentum in the economy, but the question is how you're going to get this $3 trillion. You're going to print money. You don't have enough revenues coming into the economy, because people have spent $900 billion of December 2020. People have spent $1.9 trillion in March 2021. So that money has gone. So people are not sitting on cash. The saving to GDP ratio has come down to less than 15%. It is not 20% anymore. So the myth that the US consumers are sitting on cash is not true, because in US, average people have got 6 to 7 credit cards, and they have reduced their debt because of the stimulus packages that the government has announced. So 2.7, $2.8 trillion they have gone in the US consumer market. So if you see in the last 2 months, the consumer sentiments are down, the consumer purchases are down. So once your aggregate demand is down, which is an important variable in the GDP equation, obviously you're going to have slow growth. So once you will have slow growth, it won't be able to generate momentum. And the question that market is now asking, yes, they have passed the bill of $3 trillion for infrastructure investment. How they're going to finance this? So they will either print money, or they will raise a US Treasury, which is looking very volatile at the moment, because the yields are going up, when the yields are going up, it signifies that your inflation is coming into the market. So once your inflation is coming into the market, you're going to increase interest rate. Once you're going to increase interest rate, the cost of borrowing goes up. Once the cost of borrowing goes up, your revenues and your earning goes down. So once your earning and revenues goes down, obviously it's going to hurt the companies. So once the companies
Right.
get hurt, obviously your market cap is going on the lower side. So obviously it's going to hurt markets very, very badly if your interest rates would go up. So I think infrastructure investment, yes, it will create momentum, but it won't happen overnight. It will take 2 to 3 years in US.
Great. Thank you so much for that, Shan. So people who joined us right now, we are live with Shan Saeed, our Chief Economist of Juwai IQI, on our monthly economic update. If you have any questions, please do ask us. Okay, so I think there's a comment, China is no longer buying US debt, treasuries, etc. So Shan, going back to my next question is that how do you view the equity and bond market and the risk factors entering into the financial system? I know that you mentioned before in your last two interviews with Astro Awani in Malaysia. Can you share with our valued listeners who are based in North America about this?
Absolutely. There's an asset flip. Bonds have become equities, and equities have become bonds, and everybody has become a daytime trader. And I don't see, as I said, the markets settling down very soon. The markets are whistling past the graveyard, and investors are again misreading the market. The valuation is all-time high. If I were to quote you, as of 14th August, market valuation of US equity is around $98 trillion, which is massive.
Yeah.
The telco market cap is around $1.8 trillion. Cryptos, no stomachs, no legs. Cryptos are trading at market cap of $1.74 trillion with no fundamentals. You have food market cap, at around $5 trillion. So markets are all time high because you have lower interest rates. So once you have lower interest rate, it creates asset price inflation. Once it creates asset price inflation, then you don't know where the assets are actually heading towards. And once your assets are not in the fair market value, obviously assets will take a huge correction once there is a volatility in the market. So I think asset price inflation is getting higher, and this is a concern for many investors. What I have shared with Astro Awani, I've been saying since June, there are four risks that are coming to the market. One is the systematic risk. What is systematic risk? Once you have inflation, higher inflation, and once you have higher interest rate, this will create ripple effect in the market, and the market will get very, very volatile in the coming months. Once we have higher interest rate, that will happen after 2023. The second risk that is coming into the market is the sovereign bond. $16 trillion of sovereign bond, that is roughly like 50% of total sovereign bonds in the market, are trading in negative. So imagine you have $16.3 trillion of sovereign bond trading in negative. It is just like you lend your money to someone and then you pay them the privilege of lending money. It doesn't make sense. I still remember we were invited by EPF, a sovereign wealth fund in Malaysia, one of the top sovereign wealth funds in the region, on 14th June 2016. And the first point that I shared with the top brass of EPF, that there are signals in the market. And if you just pay attention, sovereign bonds trading in negative. On 10th June, if you pick up Financial Times, sovereign bonds are trading $10.3 trillion. So from 2016 as of 2015, the sovereign bonds trading in negative have increased almost $6 trillion.
Wow.
So this is a clear signal that for free markets don't work in negative interest rate. Free market work on positive interest rate. So this is one of the factors that are coming into the market, risk factor. The third factor is the liquidity risk. We have seen September 2016 as January 2020 in the repo market, the repurchase market, in the money market. Fed injected $7 trillion at that time. And recently, 30th June 2021, last day of the H1, Fed injected $1 trillion in the reverse repo market. So people who understand money market and repo market and reverse repo market, they are pretty concerned that why Fed is injecting liquidity into the system because banks are not very aggressive in these markets, especially in the money market. So the liquidity risk is coming. The fourth risk that is coming, and this is all happening. This is all happening right now in front of our eyes. The fourth risk that is coming into the market is the equity valuation risk. For example, an Apple stock is trading at, for example, 3,000 or $4,000. It is not based on reality. It is based on the printing presses unleashed by the global central banks. Yes, US equity is trading almost close to $100 trillion, and the total US GDP size is like $21 trillion. So it is almost four times, more than four times of the US GDP. So these are the four factors that investors are concerned, and this is happening right now. And if you pick up any erudite gentleman who is sitting in US, they are saying we will see equity markets correction because they are not based on reality. So at Juwai IQI, we expect 20 to 30% correction of the equity markets once the interest rates go up. So once you have interest rates going up, obviously the cash flows of many companies get hurt because the cost goes up. Once your cost goes up, your earning, your cash flows, your revenue stream, everything takes the impact of higher interest rate. So inflation is getting higher. So how to tame this inflation? You have two strategies: either to keep your currency stronger, or the second strategy is that you use monetary tool, you raise interest rates. So Fed is not in a position to raise interest rate before 2023 because economy can't take the pressure of higher interest rate. Once the economy can't take the pressure of higher interest rate, you will continue with QE. So as I said in your last month program, I don't see the higher interest rate coming into the market before 2023. So these are the four risks. You have systematic risk, you have the sovereign bond risk, you have the liquidity risk, and the equity fair valuation risks that are coming to the market, and it's all happening in front of our eyes. So what I'm sharing is nothing new in the market. So the reason why mainstream many investors are not following the mainstream media because they are not sharing these risks. And I am being a contrarian. Everybody knows I don't follow the mainstream media. I have my views. I follow my networking from top business school, and I know my people for the last 33, 34 years from my school days in Karachi, from St. Paul's, from St. Patrick's, from Karachi Grammar School. So I only trust my networking because I know they don't have hidden agenda and they are very straightforward. And on top of that, they have all studied from top business schools, and I understand they are smarter than me.
Great. So I got a couple of questions when you're talking about it. So, okay, one of the question is that the due to the exchange rates, the 6 trillion drop in the sovereign bonds, and followed by that question is when do you see the equity corrections timeline in 2023?
The bond negativity is because you want to entice the customers or the investors that we will be able to go into the positive. That's why investors are piling into the bond market. But I have shared with Yusuf, and we have all shared, that Warren Buffett is sitting on $135 billion.
Yeah.
And he mentioned in February this year that bond is the worst asset class to be in. So bond market is not going in a positive zone in the near future, and I expect the bond market, these $16 trillion, it has already touched $17 trillion. From 17, it has gone back to 16. I expect the sovereign bonds, it will touch again 17 or $18 trillion because investors, they don't have a choice. Where do you go? You go to the equity market. Equity markets are volatile. You go into the bond market. Bond market is also volatile. So as I said, there is an asset flip. Equities have become bonds, and bonds have become equities. So it's an interchange. And the more worried we are about inflation, the more, or the worse stagflation, the more we can expect that equities and bonds, they will go into the opposite direction. The yields of equities and bonds, they will go into the opposite direction once we hit inflation or the worst stagflation. The second question is, what do you expect equity markets to behave? I expect equity markets to behave in volatility. If anything goes wrong in the market, any small risk, whether it's geopolitical, whether it's currency market risk, or whether a small risk, a policy risk that is coming to the market, yes, equity markets will take a few correction, maybe 5 to 10%. In the last 2 months, we have seen equity markets are moving in zigzag. They're going up, they're going down, they're going up, they're going down. So this will stay for the next 2 years. This is not settling down very soon. I said markets are not settling down very soon. And as I mentioned, in 1970s, what most of the customers did, they took position in gold and they took position in real estate. So if you recall history from 1970 to 1980, this is a period where gold went up by 2,200% and real estate went up by 150% globally. I'm not talking about KL or about Toronto or London
Right.
or New York or Chicago. I'm talking globally. The real estate went up by 150%. And if you check gold, $35 on 20th January 1980, gold was trading at $850. You do your quick maths, it's very simple, 2,200% in less than 9 years.
Wow.
So
Wow.
markets are not settling down very soon, and Yusuf and I, we have been sharing in these tumultuous times, in these tempestuous times. There are only two asset classes. People who understand history and economics, real estate, gold, tangible asset class, no fancy stuff, no cryptos, no equities. You cannot sleep on your paper. Can you sleep on your paper? On your equity paper? You cannot. Yes, people have made money. People have made money in bond market. People have made money in equity market. But you need a house. You need a shelter at night. So I think these tangible assets will come back. I expect commodity prices to go up. Canada is going to benefit because historically Canada is a commodity-based currency. So Canada is going to benefit in the long run for the next 2 to 3 years.
Great. And of course, I think you already answered that. Will the money offloaded from equity markets go into gold and real estate? That's what Shan just now mentioned. Question, Shan, should people buy real estate now?
Absolutely. Real estate is a new global currency. If you see our book 2015, now everybody is citing us. This book is available on the internet. It is absolutely free. The greatest obsession of my life is I am turning 48 in November. How people can leverage from Juwai IQI platform. You will be surprised to know that IQI was a very small brand when I joined on 12th August 2013. After 8 years, IQI, Juwai IQI has become a giant. It's like a dinosaur in Malaysia. It is so big. Over 19,000 agents. Our sale is over $1.6 billion globally. And
Excellent.
people continue to join IQI because of one single reason. We share substance. We don't share tabloid stories. We don't share Cinderella stories. Everything is backed by facts and figures, which is based on critical reasoning, which is based on market driven data. And as I said, people who follow Juwai IQI, they know that we share substance. Nowadays, internet is a great leveler. Whether I make a right call or a wrong call, people are quite quick and saying, Shan, you said this in 2015. Shan, you said this in 2019. You were right and you were wrong. So at Juwai IQI, we have the confidence to say, okay, I made the right call on the oil market or I made the wrong call on that. And everything is available. Everything is available for everyone. Everyone has got the same access that we have got. So people can counter check about any asset class or any forecast that we have made in the last 5 to 6 years.
Absolutely, Sean. What you just now said is right. We are one big, family, Juwai IQI, with over 19,000 agents in 21 countries, a click call away, and we do share facts. And, one of the comments which I wanted to show was that definitely is excellent knowledge and sharing, of course, by Shan Saeed on that. So, Shan, so many good comments, so many questions are coming on that. Yes, buy gold as an asset. Yes, Shan is always on to the real estate and the gold side. He said just have something tangible which you can hold on to it. So also like the Canadian real estate remains hot like USA. Do you see the moment to continue since investors are talking about the equity bubble, the bond market, volatility, and above all inflation concerns? What sophisticated and smart investors should be doing in this time? You mentioned about the Yale endowment. What was that?
Yes, Yusuf, the momentum in real estate market, especially in Canada, will continue. As I said, sophisticated and smart investors, they're going into tangible assets.
Yeah,
And once you're talking about tangible assets, I'm not the only one. Look at Harvard Endowment. Harvard
yeah,
Endowment has got 40 billion, one of the largest endowments in US in the Ivy League universities. They took position in Hong Kong real estate. Qatar Investment Authority, one of the biggest sovereign wealth fund, took position in Asia Center in Singapore, and they invested more than around I think $10 billion. So these sovereign wealth investors, endowments, they are coming into the market in a big way. So when these endowments and these sovereign wealth funds are taking position in real estate, it sends a clear message to the market that they want to take position in the tangible assets. As I said, I'm a very fundamental person. I want to touch, I want to feel
yeah,
my asset. And those sophisticated and smart investors who understand history and economics, they've always taken position in real estate. Now cryptos are coming, and people are talking about crypto, but it is not based on reality. It has no fundamentals. Regulators have not approved cryptos as such as an asset class. For me, it is just a variable, and it swings like a pendulum. It goes up 30%, it goes down 30%, it goes up 10%. So any volatility is going to hurt. So
yeah,
to your question, yes, as you said, that people are coming in Canada. Government is quite focused. They want to encourage immigration. And what the Prime Minister Trudeau has done, he has called up for snap election. That
yeah,
means he wants to check the confidence of voters, what he has done in COVID situation. So he has done a pretty good job. Markets are opening up. You have shared with me
yeah,
many sectors of the economy, they are coming back in the market. So this is a good sign for those big investors who are still viewing. I was talking to someone, and he said, Shan, my property has gone up by 40% in Toronto. 40% in less than
that's
2 years.
true. That's
So,
true.
20% return in 1 year is not bad. And you're talking about real estate, it's tangible asset. So 40% return in 2 years' time is pretty good in these. Nobody can guarantee you, 40% return, but it's only the tangible asset that give you peace of mind. And you can touch the walls of your house, you can see, and you can sell it whenever you want. It's very much liquid nowadays. So I think real estate will continue to have a strong drive in not only the Canadian market but market across continents. Lastly, I would say what Yale Endowment, if you pick up Sunday's
Sure.
Financial Times, the second largest in US, they've got $31 billion in the asset under management, and they are going on long on three things: real estate, cash, and private capital. So what does it mean? Yale is one of the top Ivy League universities,
Yeah,
along with Harvard and Stanford and Chicago and Columbia. If they are coming out of the equity market, it's available. You can share it with your valued listeners. If they are coming out of equity market, it means they don't have the confidence in equity markets. So once you don't have confidence in equity markets, obviously you will step out and you will look into those asset classes, where you will get peace of mind, where the returns are stable, and you can always, appoint your own alumni or graduate who can guide you. So the person who is running this, the chief investment officer, is a Yale graduate. The person who is running the Harvard endowment is a Harvard graduate. So all these top universities, what they do, they employ their own graduates to drive the investment landscape. And the investment landscape right now, whether we are talking about endowments, whether we are talking about sovereign wealth fund, whether we are talking about pension fund like Calpers in California, all these endowment, pension, all these funds are going into tangible assets. I wouldn't be surprised if these endowments, more of these US endowments, they come to Asia, especially Indonesia or Malaysia. As of yesterday, I can give you a big news.
hmm,
Porsche is coming to Malaysia, and they have signed up with Sime Darby. Sime Darby is
nice.
into plantation, they are into real estate, they are into automobiles. So once Porsche relocates to Malaysia, it's a big move,
Yes,
especially in the luxury automobile industry. and that gives Malaysia a clear advantage over its competitors like Singapore or Indonesia or Vietnam or Philippines. Why Malaysia? They have mentioned, I gave my interview yesterday, because of productive labor force. Malaysia, as you know, is a manufacturing hub. Penang is a manufacturing hub. Malaysia labor force, technically, they're quite sound in the engineering side. So once the investors, they look at Malaysia, they know that most of these graduates from Malaysia, they're very good at manufacturing. They're very good at, in the engineering. The engineering schools are producing some good graduates. And why Malaysia has leveraged from that, that they have done, they have specifically put Penang as a manufacturing hub. So Porsche coming to Malaysia is a big news, and
Mm.
obviously it will drive FDI. It will bring in technical know-how, technology, manpower. Real estate will go up. They need real estate for their expat employees who will be relocating to Malaysia. Productivity, income levels going up, living standard going up. So obviously it's a big boost for Malaysia. So I think, yes, real estate will continue to drive. I am quoting 2016. Sovereign wealth funds at that time were putting 29% of their funds into real estate. And as of now, after 5 years, sovereign wealth funds are allocating 35% of their portfolio into real estate. So from 29 to 35%, it is a 6% increase. That clearly signifies that, sovereign wealth funds are going big in real estate. And as I said, real estate is a new global currency, and because you can touch the walls of your house and it's real and you can feel it.
Amazing, Shan Saeed. You rightly said, it's a good news, very big news, Porsche coming to Malaysia. And when you were talking about the real estate in Canada, the friend of yours who told you is 40% up is absolutely right, because we are seeing an average of 20% increase. Even at the time of pandemic, there's so many buyers still available in the market today. I was talking to one of my agents. He was going to put an offer on $1 million home. He was putting an
Wow.
offer for $1 million home, and he told
Excellent.
me he's got 24 offers on that property. Can you imagine?
24.
24 people that
Oh,
were competing on that property. I don't know what the results are. I'm going to find out very soon what happened to that
very
property.
good.
But there was
Good luck.
24
Good luck.
people on that. One of my agents, so I'm going to be talking to him and say what happened to him on that. So that shows, the demand is still there. The supply is low when it comes to the real estate, especially when we talk about the Canada real estate market and towards the Toronto and the GTA, which is the Greater Toronto Area market. I think, as you rightly mentioned, the real estate demand will continue to grow, and what could be the best asset is something which you can hold on to your hands, and tangible assets on that. Thank you so much, Shan Saeed. Great session as always. I really, really appreciate it. The audience was so interactive. Thank you for all the audience who is joining today. Anything else you want to say, Shan, before we say bye to everybody?
Thank you, Yusuf. Always a pleasure talking to you. I'm also looking forward to this monthly global outlook, and it's always nice that people can leverage from our expertise. People can stay ahead of the market at least by 2 to 3 quarters. And for me, that is the greatest obsession, that our clients are making money and investors are always happy with Juwai IQI. I'm so happy.
Thank you so much, Shan. Thank you so much for everything. With this note, everybody, please take care of yourself. Everybody in Malaysia, again, happy Merdeka Day. Happy Independence Day to you guys. Take care and be careful. Bye bye.